Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. Okay, so last week, stocks treading water as tech and mid caps did lag a bit, but that was made up for by defensives. And then obviously we had jobs data on Friday, but it was Good Friday, so markets weren't open. So we're going to see if there's any market reaction to that today. UK outperformed in Europe, and then Japan was a little bit of a laggard in Asia. In terms of commodities, they were mixed. Gold and silver traded pretty well as gold kind of took on that 2000 level again, managed to breach it, and silver rallied pretty hard on that. It was up 4% that day. But, still not conclusive break, I wouldn't say, to the upside yet on gold. And then oil obviously firmed on those OPEC cuts that we had mentioned last week before we went away. Nat gas was still heavy, actually finishing down another 7.5% on the week, so really can't catch a bid yet. And then you had uranium and copper also on the weaker side, uranium down 4, copper down 2. US vols did actually finish a little higher if we look at floating 1 month at the money vol, but that is largely down to the fact that time is extending, right? So 1 month vol today is a different animal to 1 month vol a week ago, right? Because 1 month vol today captures the big FOMC meeting. Yeah. So you're going to see the 1 month volatility today look like a higher number because it contains an event, right? So rather than a real material bid in vol, I'd put it more down to that happening. But vol's still pretty cheap if you look at the actual headline number. And it had priced in the Easter weekend already, like we had said. So we had non-farm data. We have got CPI this week. That's the big one for this week. Commodity vols were also mainly firmer, particularly in precious metals. You had a decent pop in gold and silver on the week. And then oil vols are really the main one that was down 3.5 points on the week as you had that strong move in spot. Carry wise, we are seeing sort of uniformly positive carry across equities, which we had kind of said was going to happen as implied move first and then realized catches up with it as we go into a seasonally quiet period of Easter. China, however, still holding in negative carry territory as those implied vols are looking quite cheap now on a high 20s handle. And then most commodities also still in positive carry with only oil in red, obviously helped by that 5% gap move to the upside. It'll be interesting to see if the gap can get closed. But whilst this thing stays above the gap, that's actually pretty bullish price action in oil right now. But bear in mind, OPEC are cutting because they see a recession and they see demand weakness, right? So that's not necessarily that bullish a story as the price action might have you sort of believe. And then skew-wise, most skews were pretty muted this week. They'd already had their reset lower into the holiday period with vol coming down and the banking crisis seeming to be less acute. Seeming to be acute in our report, I mean less acute. There is still more sort of downside premium in skew than there was, say, in Q4 when no one owned the market. And that might provide some near-term support as premium decays away and people have to cover shorts, dealers have to cover shorts against that. And that's if the whole sort of cross-asset vol complex continues lower like it has been over the last couple of weeks. Looking at the charts, last week's economic data, as we said, ISM pretty low. Initial jobless claims also look like they've turned up. So not great sort of leading indicators, I would say. And that's supporting the repricing in the bond market that we've seen in terms of where the 2-year is since the SVB collapse. Now, we did have non-farm data on Friday, which was a bit more robust, albeit if you look at the detail, a lot of the strength was from the kind of the hospitality type sector, which is still recovering from kind of COVID shocks and things like that. Interest rate markets are pricing in a 67% chance of one more hike, either coming in May or June. And this jobs report likely supports that outcome unless things materially deteriorate and things really get worse over the next few weeks. We mentioned April seasonality as a potential reason why we might see some upside in markets in the near term still. April is usually fairly strong, but positioning also does support the theory. If you think about discretionary players, a lot of hedge funds have been stopped out in the rates moves. A lot of discretionary macro players are going to be wanting to see more certainty around the rates path. So they're going to want to see what the Fed messaging is over the next 2 meetings, and they're going to want to see if the data is kind of confirming stuff before they really deploy a load of fresh capital will move their books around. Okay, so that means in the short term, marginal actors who are going to move markets are more likely to be the systematic guys. And so with the move index falling lower, taking all cross asset volatility down with it, this likely gets vol control players to buy assets. That's been supporting the market. That could continue as they increase exposure if vol continues to stay low. CTAs are also seeing positive inflection in their trend following models, according to Bank of America. Chart there is suggesting that in neutral to up markets that there's a fair amount of length still needing to be added. So these guys are going to be marginal buyers. Obviously, we have got earnings season kicking off. So if the news flow warrants it, that could change the trend. But for now, those marginal buyers are likely to have some impact. Now, we mentioned defensive. So if we zoom in on XLV, which is the healthcare sector, this is a position that we flagged in early March that this was a good candidate to buy calls. The upside vol got very, very low, very, very quickly on this thing as the skew went bid and the market sold off. We thought that was an opportunity. We also saw technical momentum divergence, bullish divergence, which was making us think this thing's a buy. So that's what we were looking at, April calls. And, the rally in risk assets may continue. We obviously have had a decent bounce. If you look here, we did from early March, we did trade a bit lower. So we had a little pop there. We then traded lower and now we've had this big move up. This is now kind of back to the area that I was targeting at about 133. We bought the April 133 calls. They have kind of nearly tripled in value. We had already rolled them into May. Subscribers to our options overlay portfolio will know about that move and why we did what we did. But in general, that position's in the green now. For those who have managed to buy the Aprils and held on to them and tripled their money, you might want to think about banking some of that, given that defensive leadership doesn't tend to be a good sign for the market overall. And so that's just something, a word of caution there. But like I say, if you're still bullish into April, you might run these for a bit longer, but they've done pretty well basically already. Looking at cross asset vol and skew, we've been calling for a vol crush and a risk asset rally into Easter. We certainly got it. We've been closing out some short vol positions, VIX puts, things like that, short condors on TLT. So we covered all that stuff before we went away last week. We have also been adding some short delta plays to the book because the book was a bit too long and we want to get more neutral. The type of things we like adding, if you look at the cross asset vol and skew matrix, HYG vols got quite low again, sort of 10 handle. The skew's also been moving back down. That skew had popped, it's come back down. Compare it to equity skew. Equity skew is still more expensive there. So we quite like owning some credit downside as a way to kind of get a little bit of negative delta on the book. We also quite like silver risk reversals because the call premium that exists now is quite extreme. Obviously, they've had a big pop in spot. And actually, the fact that copper has been lagging and hasn't really managed to participate in the rally. So we're not getting a broad industrial metal type rally. We're getting a gold rally and we're getting a big sort of kind of short covering type move in silver by the looks of it. But we actually think if you own silver, it's a very opportune time to hedge that. We mentioned that last week. We stand by that call that you'd be a bit mad not to hedge some of your silver, we think, after the type of move that it's had. And then lastly, TLT, also seeing that vols compress back down below 20, but it's stabilizing there. But the skew has flipped over towards calls as well. So if you are long TLT and you like the long bond position, but there's a few little things like CPI, things like sticky inflation data that might continue for another month or two, and you've got the debt ceiling stuff coming down the pipe as well, you might want to put some hedges in place on TLT, given that it's now trading with a call premium. So risk reversals will look interesting again, basically, right? So those are the type of things we're looking at and we're seeing on our matrix. All right, that's it for today. Good to be back after a bit of sunshine. And I will catch you guys all tomorrow. Thanks a lot.